Let me introduce our speakers for today's session. We have Vijay Mantri, who's the co-founder and chief investment strategist at GRL Money. Prableen Bajpai, who's the founder of FinFix Research, and Naveen Wadhwa, who's deputy general manager at Taxman. Before we start, let me tell our audience that we'll dedicate the last 10 to 15 minutes of the session for questions. So whoever has any questions, please send us a mic request and we'll take it up in the second half of the session. So today is 24 March and we have exactly 7 days before the current financial year ends. And as a lot of tax experts tell me that many taxpayers wake up to tax planning in these last 1 or 2 weeks. And as is the case with anything which is rushed at the last minute, that it's prone to mistakes. So, you could end up picking up the wrong investment instrument, which may require a long commitment or which may require big payments every year. Or you may overlook the full tax structure of the financial products that you're picking up, and so on and so forth. So in today's session, we'll try to address all the key points related to tax planning to ensure that you pick the right tax-saving investments. Also, apart from investment, we'll tell you a few other ways that can help you optimize your taxes. So let's start with Section 80C because it offers the widest range of investment options. Vijay, we can start with you. I don't think Vijay has been made a speaker yet. So Prableen, let's start with you. Under Section 80C, which investment option do you think is the best, to utilize the 1.5 lakh limit?
Hi, Shipra. Now, this question is so hard to answer because you said that, everybody's running late to do their tax savings. Yes. And I think the suitability actually depends, from person to person. You just cannot say that which is the best option available. There may be few people who need not do any investments under ATC and just, pick the new tax regime as well. So, but broadly, if I have to say under ATC, I think a couple of things here. Number one, that, your tax planning has to be a part of your overall financial planning. So while choosing a product, it's so important that you consider that it's not like an investment for the next 6 months or just the next 1 year. It should be nicely integrated into some part of your, overall financial planning, probably associated with a goal, a long-term goal such as retirement, or even if it's from pure tax saving point of view, then also what is the suitability? Do you have a fixed income portfolio? If you don't, then probably you can go in for an product like EPF or PPF. And if you do have something in fixed income, which is other than these, then maybe, something in equities. So I think, Shipra, the answer, cannot be just given that which is the best product, but I think some of the preferred options, according to me, are, of course, employee provident fund, your public provident fund, and tax saving mutual funds. I would go with these three broadly.
Right. So risk appetite is what you touched upon. Other factors I think which matter are one, liquidity, and two, the cost. So Vijay, let me come to you. Why don't you share your opinion, based on these two factors that I just mentioned, depending on liquidity and cost, which options do you think make the best fit under ATC?
See, if you look at first from the commitment perspective, then the ELSs have the shortest duration as far as lock-in is concerned. Is a 3-year duration product, and cost is also very competitive compared to any other product. But ELSs are subject to, as you know, these are equity-linked instruments. They are subject to volatility. But suppose your holding horizon is a bit longer, then I do not think there's any other product which even come closer to ELSs. So for instance, I'll just give some input on the ELSs. If you look at ELSs product and if you look at PPF, which is the most popular tax saving product for most of the people, PPF give predictability of the return. So once you invest, you know that this is the minimum you're going to get. Definitely year on year, the rates keep changing based on what is happening to 10-year GSEC and what the central government decide. Beside that, if you look at ELSs and suppose you end up picking the worst ELSs and you end up investing on the worst day of any financial year, worst day means that funds NAV were the highest on that particular day. And if you invest regularly every year, Now forget about SIP. You pick the worst fund and you invested on the worst day. Then a 15 to 20-year period, the comparison between ELSS and any other product is not in percentage term, but in multiples. So the growth in ELSS is 3 to 5 times, in some cases even 10 times more than what you find in traditional investment product. However, it is subject to volatility, so that need to kept in mind. If you have a tolerance for volatility and if can be explained to you properly, that I think ELS is a great investment. Second thing, just like PPF, you don't have to commit fixed amount every year. For instance, in PPF, you just can do it with 500 rupees every year. You don't need to commit 1,50,000 every year. Unlike an insurance product, once you commit something, you have to stay committed at least for a 5-year period. In ELSs, that is not the challenge you have. So you can invest this year, next year you can choose another product, or you don't need to invest, you don't invest. So ELSs provide you that kind of flexibility. So just keep that in mind.
Right. Yeah, Prableen, you want to say something?
Yeah, I just want to add some more data to what Vijay has said. That, of course, because equities as an asset class definitely beat any of the fixed income products. So I just wanted to give some figures. So let's say if somebody is investing about 12,500 on a monthly basis, and EPF is now giving lesser returns, about 8.1, and then 7.1 for your PPF. And if we take equity returns at 11%, which is I think not very high, and we take a 25-year period, the corpus at the end of 25 years, considering the extensions in PPF, so PPF would be about 1.03 CR. Your EPF will be 1.21 CR, and your ELSS will be 1.98 CR. And of course, because there will be taxation in ELSS, so taking out that sum of about 20 lakhs here, it's still about 1.7 CR. So there's a huge margin by which it wins. But I think again the catch what Vijay said, that you have to be able to withstand the volatility and stay invested during this time horizon to reap the benefits of compounding.
So I just would like to add, Shipra, here a little bit. Uh, if we don't know what will happen next 1 year, 10 year, 5 year, 20 years, but just look at what happened in last 5, 10, 15, 20, 25 years. So you have a ELSS product, which is, I think, 26, 27 year of track record, compounded money at around 25% per annum. If you look at average ELSS return, like the average of the category for last 15, 20, 25 years, the average numbers are really staggering. So they are in the range of around 18%. So in past, your money compounded at the rate of 18%. And equity returns are linked to what happened to GDP and what happened to inflation. If the inflation number rises, equity return also goes up. If the inflation number comes down, equity return also come down. So it is not that when you look at equity return and you say what will happen to future. So suppose you look at next 3 to 5 year or 10 year, and if you believe that interest rate is going to come down, then even 10% would look very good, because perhaps at that time the fixed return product will not offer you that kind of return. And please remember, ELS's return, PPF return, which are below 8%. When it started in 1960s, the PPF return was just 3%. It went up to 12% in 80s and remained there for at least 20 years around that number. So people who have seen life after 80s believe that PPF is a great product because in their lifetime the product had delivered 12% return. Just keep that in mind.
Okay, so ELSS is clearly emerging as the winner here. But so during this time, traditional insurance policies and ULIPs are sold aggressively. So let us also talk about that. Naveen, why don't you? Well, let's start with the taxation bit of insurance policies first, and then we'll get to the returns and other things.
Yeah, sure, Shipra. So before we begin, I need a confirmation if my voice is audible and clear.
Yes, you're clearly audible.
All right. So, since Prableen and Vijay, they have given their perspective from the investment angle, but I want to give a different perspective before you decide where to make the investment, and especially I won't say in the last 6 or 7 days before this financial year ends, but overall how you can make planning of your investment. So besides your income, your long term planning, I also want to tell to the listeners to keep a track, to keep a watch on their age and their location. So why I'm saying that, just take an example. So if let's suppose you have just started your career and you don't have much obligations towards your family and you have got good cash in hand, so in that situation, so my first suggestion would be you should always go for the term insurance at the beginning of your career, because your age is less. So once you start the term insurance at early age, your whatever premium decides today would be payable during the entire tenure of your term insurance. So that's my first suggestion to every youngster who has just started his career. Number one. Number two, or if again you have just started your career, so my suggestion would be you should start making contribution to the EPF, because again this is, I would say, this is, there are very few options in the income tax act which comes under E category, means exempt and exempt category. So just leaving the amendment made by the budget 2021 last year. So PPF, EPF, and Sukanya Smridhi scheme. These are very few schemes which gives you exempt at all three levels. So that's my point number two. My point number three. So if you are not from big cities, you are from small cities where the property rates are little less in comparison to the metro cities. So my suggestion would be start planning to buy a house. If possible, take a housing loan and buy a house. So whatever interest you are paying and whatever principal amount you are paying, at least you can claim a deduction and exemption for the interest and the principal amount. So that's my point number three. If your age grows and now you have a family, now you have more obligation to make financial contribution, so in that case, before deciding where to make an investment, so first identify all those expenditures and investment which are by default available to you, like uh, tuition fees of your children, and the remaining amount you have, you should make an investment. I am personally not in favor of endowment policy, complete insurance policy. If you are really looking for an insurance policy, first preference should be given to the term insurance, because in endowment policy, you don't. I am not talking about ELSS or ULIPs. I am just talking about pure endowment policies. So endowment policies should be your last choice. Your first choices should be definitely term insurance if you're looking for an insurance, pure insurance product. And thereafter, if you want to make an investment, you are not pro of making investment in the stock market, then always go for mutual funds, because they are professionals who can take care of your investment. So that's my last suggestion. And I would recommend you to follow these investment ideas in the same hierarchy.
Right. One very important point that Naveen made was that, I mean, two important points. One, that you should decide the investment option depending on which, your life stage, and second, also looking at the full tax structure. So let me ask this question again, Prableen, why don't you take it up? That how important is it to look at the full tax structure? And do you think that it's a common mistake that taxpayers overlook tax structures, in their hurry to just save tax for this current financial year? Prableen, you're on mute. Hello, am I not audible?
You are audible. Prableen is on mute.
Sorry,
Vijay,
sorry, Shipra, I was not able to unmute
yeah.
myself. Sorry, can you just repeat the question?
I was talking about how, looking at the full tax structure of each product, I mean, the product that you're looking to pick is important.
Absolutely, absolutely. So, while doing your, tax planning, see, ideally, Shipra, this is more like a compulsory sort of a saving that one needs to make. Okay, so there are two categories of people, like, Naveen also touched upon. There are people who can comfortably, they have, kids who are going to school, and they can avail the tuition fee. They may be even having a home loan, but they are more interested in the interest part, claiming the interest part, and they're happy to do their EPF, and they have all these options, right? So, in fact, a lot of people would have a spillover over and above the 1.5 lakh that you can actually save in a year. So, there is this category of people also. But then somebody who has to make a conscious effort now to see that where do I invest, definitely looking at your the exemptions at each levels, your maturity, the exemptions at maturity or tax structures during the full course, I think is very, very important. And as I'd mentioned earlier, that bringing it together with your overall finances, your structure, how do you see your own career? So let's say for somebody who's just picked up a job as a graduate, and I've come across these cases where maybe you're in a rush to do some tax saving now, and you end up parking your money, let's say, in an ELSS because it's got the minimum lock-in. And now you, after 2 or 3 years of working, now you quit your job and you want to do your higher studies or move abroad. So having a bit of clarity on how you see your own future is equally important while doing this whole math, because now this person is in a rush because he wants to take out whatever money is possible from his ELSS so that that can be used otherwise. So I think I would strongly recommend that, of course, not only see at what returns, what deductions you're getting everywhere, your tax benefits, but also how it actually sort of is you're able to fix it with your overall financial planning as well as your own future plans. And I think the new tax regime, though we are not talking about that as of now, but I think that should also be availed. Don't just rush to invest in a product. Please understand what is best for you. And if you've not been able to understand that, then I think for somebody, I'll give you an example here. So for somebody who's earning about 20 lakhs and is only doing 1,50,000 under ATC and taking the standard deduction, that's it. If nothing else is claimed, will be paying higher tax with the old tax regime vis-a-vis the new tax regime. So I think that the person has to check what is better for them, and I feel it's a very nominal difference. And if you're undecided, go with the new regime and then do your proper planning and then go and invest. I think in the best suited product.
So one question here, Prableen, would you say, do you have any 1 or 2 thumb rules that taxpayers can follow to decide whether the new regime works for them or not?
I think the best thing here is, Shipra, that you calculate what all are you going to avail as deduction. Are you going to avail exemption for HRA? Are you going to avail exemption for LTA? Are you going to use your other home loans and, the interest payment amounts and all? So once you know and what is your tax liability overall, I think then it becomes really clear for the individual to decide what is more suitable. So if somebody is again in a 20 lakh slab and is doing all these things, let's say a basic HRA, a basic LTA, will be beneficial, will be benefited if he or she is following the old regime. So I think the first thumb rule is that you do all that math, basically check what all deductions can you claim and see the comparison, broader comparison. That's the first thing. Second, I think it's so important to know, like I mentioned, what is your own plans going forward in the future? Are you in a corporate job and are you looking to quit and then start off something of your own? I have just come across such a case, and there, that person's in tax liability is going to become almost nil in the coming financial year. So where are you, in the life stage? And of course, these two things are, I think, are very important so that you don't get stuck with the product that this year, okay, let me just put it in PPF, and then you're stuck for a long time, and then you don't want to use it again the next year. So I think doing that, the suitability, in sync with your future plans, and of course, your overall deductions, what you would be availing. I think these two things are very crucial.
Right. One more point that I would like to add here is that as per the tax rules, salaried individuals can switch between the 2 regimes every year, whereas business professionals or those with a business income can only do so once in their lifetime. As in, they can select the new regime and can come back only once in their lifetime. So that should be noted here.
Shipra, can I make a few more points in relation to new tax regime?
Yeah, sure, Naveen.
All right. What I would discuss in the next couple of minutes. So I'll divide this entire discussion into 3-4 parts. So one is, let's suppose you're not claiming any deduction or exemption, means no ATC, no 24, no HRA exemption, nothing. That generally happens in case of a non-resident. So if that is the case, you are a non-resident or you are not claiming any deduction or exemption, then the new tax regime will definitely be better for you if your income is above 6 lakh rupees. So that's point number one. Point number two, so you are not claiming.
Naveen, just one question here.
Hmm.
So, like you said, that somebody who has an income of up to say 6 lakh and say he's a
Not
salary
up to above 6 lakhs.
above 6 lakh. Okay. Okay, so even then, okay, so like, what is the income that we're actually looking at? Because above 6 lakh is also 9 lakh,
So
six point
whatever
five lakh.
income it is. So I have given one simple thumb rule. If you're not claiming any exemption or deduction,
Okay,
then you should go for new regime if your income is above 6 lakh rupees.
all right.
Right? So taking the second scenario wherein you are just claiming deduction under section 80C. All right. In that situation, the new tax regime will be better for you if your income is above 8.5 lakh rupees.
Okay,
All right, because at 8.5 lakh, the tax in the both old and new regime will be at break even point.
okay, okay.
Right. So now taking the next scenario. So let's suppose you are claiming section 80C deduction and 80D deduction. Here the break even point is 12.25 lakh rupees.
All
All
right.
right.
So for
So
one more thing, for salaried individuals, they also have a 50,000 standard deduction available.
I after claiming all those benefits which are
Okay,
allowed,
all
right?
right.
So taking another point. So let's suppose you want to claim 80C, 80D standard 24B. So you should not go for new tax regime. It will not be beneficial for you. So that's
Naveen,
a simple.
Naveen, can you please tell our listeners what is
Oh,
what is the
I'm so
deduction
sorry.
under
I'm so
24B?
sorry. I thought
No
these are very
problem.
common. So ATC we all are aware of. ATD basically is for the medical insurance premium which you pay for yourself and for your parents and for your family, means immediate family, your wife, your children, and for your parents. And then 24B is basically interest on housing loan. So if you are claiming, these are very common deductions you claim, and in fact I would say every taxpayer about 27 or 28, you will definitely find these three options very common in all these taxpayers ITR. So if you're claiming interest on housing loan, ATC deduction, and your medical insurance premium, new tax regime is not for you. Go for all tax regime.
Right. Right. So whoever is looking at the new tax regime, please make the calculation, compare the two, and then take a decision. Okay. So another instrument that I want to talk about is NPS because it also offers 50,000 additional tax deduction. It is low cost and also is partially tax exempt on withdrawal. So Vijay, how do you think? I mean, what is your opinion on NPS as a tax saving investment?
See, NPS, as far as additional 50,000 rupees concerned, is a good product because that 50,000 rupees exemption is not available in any other section of the Income Tax Act. As far as 1,50,000 is concerned, I think ELS is a far superior product for various reasons. But for this 50,000 rupees, which you get under Section C10 CCD, I think it is one of the best product available right now. So if we have wherewithal, I think we should use this Section 80 CCD option tier 1. And if you are a young guy, then go for 100% equity options. But for 1,50,000, ELS is a far better option. Second thing, the most important thing people need to keep in mind before doing tax planning is to do their financial planning. Because there are many instruments in which when you invest, things are tax free, but they don't have grandfathering clauses. So for instance, when you take housing loan or when you pay interest on housing loan, the law keep changing, the limits keep changing. Just few years back, suppose you have a house which has been rented out, and suppose you are paying interest on that, then to whatever extent interest you are paying, net of your house rent, everything can be, suppose the property is in losses. You have 1 crore rupees house, you're getting 3 lakh rupees annual rent, and you're paying 6 lakh rupees interest, then 3 lakh rupees is a loss on house property, which could be adjusted against any income. And for salary class, that was the only loss available. But that now has been capped at 2 lakh rupees. PPF, EPF, VPF, and insurance product have grandfathering clauses. Any changes happen would happen to subsequent investment. Past investment will not get impacted. In ELSS, the grandfathering is not available. So when investors do their tax planning, before the tax planning, it is very important they do their financial planning, understand the complication of grandfathering, and don't try to be too cute on tax saving, because we have seen many people creating HUF and got stuck for life because HUF have many other complications going forward. So just keep that in mind.
Uh, I need to correct one thing. So, Vijay, you mentioned that losses from rented house property, maximum 2 lakh rupees can be claimed. That's partially correct. So, you can claim the set off of up to 2 lakh rupees in the same year. So, if you have got some losses remaining to be set off, that can be carried forward for next 8 years.
Yeah,
So,
that's very
that's the correction
that
I
that's true.
wanted to
That's
make.
yeah, that's true. Yeah. But earlier it was unlimited, so it was bonanza for many people.
Yes, since because it was being misused by many taxpayers, that was the
Yes,
reason
yes,
this
yeah,
amendment was made.
yeah.
So, Shipra, over to you.
Right. So coming back to life insurance products, because these are aggressively sold in these last 3 months. So they are attractive because again they offer uh, tax exemption on the premiums. There's no tax on the interest. I mean the yield, and it is also the proceeds. The maturity proceeds are also tax exempt uh, under certain conditions. But what, and also when they're sold, they are, I mean the yield that is shown to the to the policy holder is shown in a way that it hides the real returns that the policy holder will earn on the policy. So Vijay, do you want to say something on the traditional insurance policies and why they are a big no when it comes to tax planning, or I mean they're a big no when it comes to investment
See, I
completely?
started my job in 1990. The first product I invested was LIC, because that was what people used to come in the March end and will tell you that do your tax planning and invest that kind of money. So all of us who was born in started working in 90s and 2000, the first investment, because you don't know didn't knew too much about, so you end up investing. Now it's very interesting to see the insurance policy which are maturing, which are 20, 25, 30 years old. You're getting 6%, 7% return. And just remember 20 years back, 22 years back, 10-year GSEC was 12%. RBI relief bond was 12%. At that time, 30-year GSEC was around 14%. So if that was the kind of return you were getting, a AAA bond was 18, 16%, 18%. During that regime, suppose somebody's invested in AAA bond, reinvested after 5 year or 10 year or even a 10 year or 10-year GSEC and remain continued invested, the return would have been compounded minimum 9%. But what we get in insurance is 6%. So traditional endowment plans are a strict no, because it does two, three things to you. One is that it makes you commit a certain amount every year. There's a one part. Second part is the returns are substandard. Third part, which is most dangerous and which is very unfortunate part, the primary goal of insurance is protection. But what insurance end up selling is investment product. So it is because of that the insurance has become a push product rather than a pull product. Third, which is very important thing, a lot of insurance investment happen because they would say after 10 year or 15 year or 20 years you'll get fixed amount every month, so on and so forth. Now that doesn't have, that does not allow you flexibility. You will get that money whether you need it or not need it, whether you need more, whether you need less. So that doesn't allow you that kind of flexibility. Second part is that okay, endowments and all those are bad product. Let's look at ULIP product. Now, when you look at the ULIP product, it's very interesting. The ULIP fact sheet which is shown to you is net without expenses. And when you redeem the ULIP, they will charge a lot of expenses. So when you buy a ULIP product, they will tell you that you can take money out after 5 years. But when you take money after 5 years, the return or the NAV or the corpus value which is shown to you is not what you get. You get net of mortality charges, fund management charges, and so on and so forth. And interestingly, I just looked at a couple of ULIP product. They have anything between 8 to 15% invested in ETFs. Now, why would I pay 2% through insurance product to own ETF? So in my opinion, ULIP endowment product are a strict no-no. If you want to go for, absolutely go for term plan. Beyond term plan, don't confuse investment and insurance. Insurance is for protection. And because of insurance companies are pushing investment product, lots of Indians have not been protected properly in the eventuality of some misfortune thing happen. So I think just keep that in mind as a listener.
That's right. One thing that I would like to add here, so for a story that I'm doing on insurance policies, traditional insurance policies, I just did some maths, and what I found out was that if you buy a traditional endowment policy, which has an annual premium of about 50,000, the insurance cover you get is 5 lakh, and the maturity proceeds that you get is around 18 to 19 lakh after 20 years. Whereas if you buy a combination of a term plan and even PPF, let's not even talk about ELSS, then what you get is that you're paying 5,000 premium for a term plan, which is giving an insurance cover of 25 lakh, as compared to 5 lakh, which you'll get in an endowment policy, and the remaining 45,000 when invested in PPF is will earn you about 8.1%, which is the current PPF rate,
Yeah,
EPF rate.
yeah.
So yeah, just some maths for our listeners. Okay, so
So I
yeah,
think Shipra is very important to salute what is right. I think if you look at mathematics, it doesn't make any sense to buy insurance product, particular investment product, but you have to salute the sales skill of insurance guys or of the insurance industry.
right, that's right. Okay, so that's about investments. Now, apart from making tax saving investments, what are the other ways to optimize tax? So let's start with you, Prableen, and then we can ask Vijay and Naveen.
Right, Shipra. So, couple of things here. I think uh, three things I like to mention. The first is I think for people in income, higher income slab, I think uh, as against FDs, I think debt options, debt funds are a very good choice that they can keep their money in, because unlike an FD where your during your tax filing, the interest is added to your income. That doesn't happen in a debt product, and there are a lot of people who think that I'm not going to use this money, I'm just going to park it in the FD and it gets reinvested every year, but there is a tax liability every year. So I think that is that is one segment where people, especially in the higher income slab, can actually save taxes. Second, Shipra, I think money which is not for immediate use, but for near term use. I think use of arbitrage funds is also a good choice because everything else remaining the same, arbitrage funds, even in the short term, would be taxed at 15% as against if a person is in the 30% slab for a near term goal, 6 months to let's say 1 year. Returns remaining almost equitable because any FD or any other debt product would also not give very high returns during such time periods. Third, Shipra, is how you can use your capital gains and losses and set them off against each other, which is called the tax locus harvesting. So a lot of people are often averse to, they add a lot of schemes and then they're averse to booking losses. So sometimes booking losses to sort of clean up your portfolio can also be helpful because that loss can later be set off against a gain in your capital gains. And I think that is one thing which is not often utilized and should be. So if you have a loss in a certain product, you have a capital gains loss that can be carried forward again till 8 years. And if you have a gain later, that can be set off. I think so. That's another thing how the tax liability overall can be reduced. And I think this time of the year is a very good time also to split if you want to book your profits because you can almost use that limit up to 1 lakh which is there, especially in equity products where there is no taxation. So if you're looking at booking your profits for a certain goal, this is the time when you're looking at redeeming. You can always split it up between this financial year and the next financial year. So broadly, these are the things, and debt funds also give the indexation advantage. So I think that also really reduces the tax liability for people who are looking to park their money for 3 years plus in a fixed income sort of product.
Right. Vijay, anything you would like to add?
I think it's very interesting when you look from a taxation perspective. Every year, immediately after the budget, which get announced now on the first Feb, investors should look at their entire capital gain statement, ask from their mutual fund advisor or their RIA, look at how much gains or losses they have on the entire portfolio realized, and book up to 1 lakh rupees in every PAN number. They should book the long-term capital gain. If they have a gain somewhere, they can adjust against if they have losses on the books in their portfolio. Now, in the mutual fund, the beauty is that you don't need to redeem. You can just switch the plan. So, suppose you have gain and you have losses somewhere, you can switch the plan from dividend growth plan to dividend and come back after 3 days. So you haven't hit the exit load if there's exit load anywhere. So one thing one need to do is to just take full advantage of 1 lakh rupees losses in every file, 1 lakh rupees long term capital gain. Second thing, which is I think is very interesting to keep in mind, is that when you invest in a debt mutual fund, and suppose you invested in 3 4 debt mutual fund, and suppose you have losses somewhere in debt mutual fund, that loss can be adjusted against gain you have in other part of the portfolio. But suppose you have a two FD, one of DHFL and one of HDFC. Now in HDFC FD, you have an interest coming for, on that you have to pay taxes every year. Suppose your DHFL FD on which now there's no payment coming, interest is also not coming, the losses you have cannot be adjusted against the gain you made from HDFC Limited FD. So investor need to keep that in mind. Third factor to keep in mind is that today we are in a rising interest rate scenario. So suppose you invest in a long-term FD or even a 3-year FD. Suppose interest rate is 5%, you're locked in for 5 years even in the compounding FD. But suppose the same money is invested in mutual fund, where mutual fund does investment in various kind of securities and interest coupon come every 3 to 6 months. So the coupon get reinvested at the higher and higher interest rate scenario. So we have seen even the rising interest rate scenario, even in the falling interest rate scenario, even the volatile interest rate scenario, as long as your time horizon is decent, 90% of the time, even on the gross basis, a debt mutual fund outperform the bank FD. And today we have very interesting products available which can match with your investment horizon. You have a maturities plan, you have what you say Bharat bond, which are a fantastic product available. You can, from this day, you are very clear 3 to 5 years down the line what kind of return you are going to get. You get indexation benefit, so keep that also in mind. So mutual fund provide equity, provide you far greater flexibility and much
Right,
more tax efficient return. Just keep in mind here.
right. Thanks, Vijay. So, since we're running out of time, I've asked Samir, would you like to ask a question now?
Yeah, Neil. I just had a small query. Um, am I audible?
Yes, you are.
Yeah, I just had a small query. What if I just plan to, for example, I have both PPF and NPS as my investments, considering them as investments. So I'll withdraw from the NPS plan, just continue with the PPF, and what I'll do is I'll invest all of the things that I have and push them into ELSS so that I can have the maximum tax benefits, because currently ELSS are the best ways to do it. What are your views on it? Should I be like, would that be a right thing to do?
So, we will ask Prableen in a minute, but as far as I understand it, you can't withdraw from NPS at will unless you cross the age of 60. So, that could be an issue. Prableen, do you want to
Oh,
add to that?
oh, I thought it would only be PPF, not not NPS. Anyways, if any of my savings, if I just park it into LSS, how would that be entirely?
Hi,
Considering
Samir.
considering that as the sole option of my investment.
Okay. See, I think don't, just because you've heard us say that ELSS can give better returns, please don't jump, into buying ELSS only. A couple of things here. Fixed income is also an important part of the overall portfolio. And let's say if EPF, because it's almost a compulsory sort of a deduction which you have to
Yeah,
make or your employer is going to do, it's okay
yeah,
to use it as your tax saving option. It's okay.
correct.
Like in the army, there's a fund called the DSOP fund. So every army officer puts almost up to 40,000 there, so they are easily going beyond the 12,500 into that provident fund
Yeah,
on a monthly basis.
the threshold.
Yeah,
Yeah,
yeah. So that's okay. You can invest and use that to build up your fixed income product. And you can always go and, according to your financial goals for your retirement, invest in regular open ended mutual funds, buy an index fund to start with, buy one or active fund based on the research you do and based on your financial goals broadly. Because even those will give you the same amount of returns because the asset class is the same. It's equities. So a regular mutual fund will also give you good returns. And it's okay
correct.
to use your EPF for your tax saving. You need not do it via ELSs there.
Got it. Yeah.
Yeah.
Naveen, would you like to tell Samir under which conditions, withdrawal under NPS and PPF is allowed? Because NPS is
So Shipra, I think I'm not the right person to comment
okay.
on these schemes because I can tell you the taxability of all these investments and withdrawal therefrom, rather
Right.
than when and how to make investment and when and how to make the withdrawal from these schemes.
All right.
So
So from that,
can I Shipra, can I explain?
yeah, please, Vijay, please go
So
ahead.
Please, Vijay.
for the medical needs, for buying house, for child education, for child's wedding, these are 4 5 reasons for which money can be withdrawn from EPF, from PPF, from VPF.
That's right.
Yeah, and
Uh,
that also broadly applies to NPS, I believe.
I
We have
spoke,
the
yes,
yeah,
NPS as well, yes.
yeah.
so with NPS, the additional this thing is that uh, you need to be in NPS for a minimum of 10 years to be eligible for withdrawal before retirement. Whereas with PPF, it's 5 years. I think that's the only difference.
Yeah, I think the one biggest advantage which EPF has over NPS is that NPS is market linked versus EPF and VPF is, suppose even it is reduced 8.1%, it is 8.1% with sovereign guarantee. 10-year GSEC is 680.
Yeah,
That's right. Okay, so
Yeah,
there's
let me just finish that
there's
point,
other thing
Sandeep. So,
that there's other thing that Neil pointed out. I suppose Neil, it was you who pointed out about if a guy belongs to a tier 2 or tier 3 city, he should buy a house. It was you who pointed it out, right?
no, I don't think so.
No, one of the speakers I heard.
I
I'm
think
sorry.
yeah,
Naveen
it was
spoke about it.
Naveen.
Naveen spoke about it.
Yeah,
But
yeah. It was a
I just
lovely actually.
Yeah,
Yeah,
Samir,
yeah. Please.
I would just tell you on equity investing. Whenever you look at equity investing, just don't look at historical return of last 1 year, 3 years, 5 year. You should always look at the worst return. What has been the worst 1 year return in equities? Around 58% negative. Worst 3 year return has been 33% negative. Worst 5 year return has been minimum 10% negative. Just keep that in mind. So suppose you're looking at investing, it means that below 5 year is not the right investment horizon for investing in equities.
Yeah, yeah. Thanks for that one, Vijay. But I actually do that to to sort it, to filter it out. And one thing which Naveen pointed out, like if a guy belongs to tier 2, tier 3 city, right? Because the if the real estate is not that of high level, if real estate is affordable there, not as tier 1 cities, then the guy should if he is working newly and has started accumulating funds, probably most of the people whom I have spoken with, they say don't buy land, don't buy home, because there would be non-performing assets and that would be a burden. But I don't think if I buy that in tier 1, then that would be a burden. But as Naveen suggested, in tier 2 and 3, that actually makes sense buying there, because the future value, we don't know how exponentially it would rise. So that was a fantastic point, Naveen.
Yeah, thanks, Amir.
Till today I have spoken to even people belonging to other finances, like phenology people also. I have spoken to a lot of people, and every single one of them has told me don't buy those things. They are NPAs, they'll build up on you. But belonging to a tier 2 and tier 3 cities, that we don't know how exponentially it would rise. If it explodes tomorrow, we are sitting on a pile. Who knows?
Right.
Agree,
So
agree.
real estate can be a topic of discussion for another event. I'm sorry to interrupt, Sabir, but
Uh,
we need
No,
so
to.
no
Ship,
issue.
Shipra, since we would be closing this event in next 5 minutes, I think I have a very important point to make. So if there are no more queries, I would need one last minute
Yeah.
before this event ends. So I'm just telling you before that.
Yeah, yeah, please go ahead.
All right. So the that important point is since we have seen COVID pandemic in last 2 years, I have seen people investing their lifetime savings in medical treatment. So that's one point I think I should make. So guys, I know you all are not aware about the technicalities of Section 80D, which allows you deduction for the medical insurance. So if any one of you have spent money on the medical treatment of COVID 19 of any person whose age is above 60 years, whose age above 60 years and he does not have any medical insurance policy, then don't forget to claim a deduction of 50,000 rupees for yourself. So I would make two pockets. In one pocket you, your spouse and your children, and in other pocket your parents would come. So if you have spent money on either COVID treatment or any medical expenditure, be it for your dental treatment, for your normal sugar diabetes diseases, you can claim a deduction of rupees 50,000 rupees for pocket one of your family and the pocket two for your parents. So these are the additional deductions you can claim in your income tax return. So just keep this point in your mind while deciding, while submitting your investment declaration to your employer, so that no extra taxes are deducted from your salary income. So
Naveen, is
that
there an upper limit on that? How much you can claim for COVID-19?
there is no limit. No limit in the sense there is no specific limit for COVID-19. The upper limit is 50,000 rupees, both for your family and for your parent family, means 1 lakh rupees.
So upper limit is 1 lakh, Neil.
Okay, fair enough.
Yeah.
Yeah, Shipra, go ahead.
Yeah, no, just one point that I was going to make here is that, like Naveen said, that you can claim 50,000 for your uninsured senior citizen parents. So if you're planning to buy health insurance as a last minute tax saving, measure, you can defer that option until the next financial year, because you'll only be able to claim either the expenses that you've already paid for or the medical insurance. So,
No, no, Shipra. That is for 80D deduction. These
right.
80C investments are add-on. These are the additional points. So my suggestion would be at this point of time. So rather than taking a decision in hurry of making investment in any endowment or any insurance policy, so guys, if you are young, go and open a PPF account. If you are about 30-35 years, go open an FD. I know FD is the most least attractive investment option, but you don't have any other option. Rather than making an investment without doing much research, go and open an FD account for 5 years and then claim the deduction at least for this year, so that from the next year you can have a proper planning of you can choose a better investment product. Because though Vijay has given you good suggestion of investing in ELSS, but you can't uh, go onto the market and choose any ELSS. Again, you have to make some research. You have to choose the better ELSS product which can give you good returns over a period of time. So see, you don't have much time, so I would say these are the two options. If you are married, just check your bank account, how much tuition fees you have paid for your kids. If you are already have fulfilled all your obligation, your kids are not going to school, so in that case you can go for EMI repayments. Again, if you are you have just started your career, not married, just check how much you have invested to PF. Again, if you don't have any of these options, go and open a PPF account. So these are few simple points I want to make.
Yeah, Prableen, you want to say something?
Yeah, Shipra, just a quick point that, I think while doing all the tax planning, don't just squeeze yourself too much, making all these investments and not keeping any liquidity with you. I think that's very essential. I just came
That's
across a
right.
case where somebody wanted to withdraw 1.5 lakhs from his contingency fund so that he would be able to, put that money in ELSS for availing the tax benefit. I think that's a very, very wrong approach. It's so important that you maintain liquidity. Don't try and, just plug up all the holes to reduce your tax liability. It's okay if in a certain financial year your tax liability is slightly high. I think this needs to be done in a more planned manner. And I think maintaining liquidity, a buffer is equally important for any contingency.
That's right. And of course, as we discussed, that people can also look at the new tax regime instead of
Absolutely, absolutely.
making. Yeah. All right. So the time is up. So I'll have to,
Chipra,
Vijay,
just
do you
last.
want? Yeah.
Chipra, can I make last comment? One often ignored section is Section 80T of Income Tax Act, in which saving account interest up to 10,000 rupees is tax free in the hand of investor. Suppose you have 4% interest on saving account. Some banks pay more. Then up to 2,50,000 rupees you can keep on an average per family member, and that will be 4% tax free, guaranteed, easy liquidity. Second, you can also plan through your, suppose you have senior citizen in your family, there's additional tax benefit available for interest on bank FD for senior citizen. You can use that up to 50,000 rupees, additional deduction available for bank FD. So just keep 2-3 points, these things in mind.
That's right. Okay, so it's 8. Thank you very much to all the speakers for joining us today and to our audience for taking out the time to hear us. I hope that you got some useful tips for your last minute tax planning. Thanks a lot, Naveen, Vijay, and Prableen.
Yeah, thanks, Shipra.
Thank you,
Thank
Shipra.
you.
Thank you,
Thanks,
Neil.
everyone.
Thanks, Neil.
Thank you, Naveen. Thank you, Prableen. Thank you, Neil.
Thanks, Vijay.
And
Thanks,
Shipra.
Naveen.
Thanks,
Yeah,
Naveen, as well. Thank you, all of you.
All
yes,
right.
thank you guys. Thanks a lot.